Good morning. This is Neil Polymus. I want to welcome you all to today's webinar. The topic is Forecasting Economic Time Series using Statgraphics Centurion. This is a topic that's actually quite dear to my heart. The first job I had after I finished graduate school was teaching down at the University of North Carolina in Chapel Hill at the Graduate School of Business, where I taught a course on time series analysis and forecasting. And as you might guess, it was a little bit more difficult in those days to fit all the different types of time series models that we fit today in just a second or two. So things have changed a lot, and it's still, though, a great topic, and I am quite happy to be talking about it today. I know I do spend a lot of time talking about quality-related data. It's nice once in a while to talk about other topics, and there are quite a few folks out there who do use Statgraphics for analyzing economic data, and I can tell by the number of people that have signed up and actually tuned into the webinar today that there is considerable interest in the topic. So I'm happy to be able to talk about it. I thought I'd start with a definition of a time series. And I looked around on the internet, and I did find that in Investopedia.com a definition that seems to capture most of what we mean when we talk about time series. They define a time series as a sequence of numerical data points obtained in successive order, usually occurring in uniform intervals. I mean, we can talk about it as being a realization of a stochastic process and things like that, but basically what a time series is just a sequence of data recorded over time, and typically it is recorded at uniform intervals. Typical examples of time series that you might be interested in are things like daily closing stock prices. I think all of us who are interested in the market have probably tried to take particular time series of closing stock prices and see what we can do about forecasting what's going to happen in the short run to particular securities. Other examples are monthly unemployment rates, and I have talked about that briefly in some previous webinars. And of particular interest today is going to be quarterly GDP, gross domestic product, which is an interesting time series to forecast and to monitor because it is closely related to the health of the economy. We're going to need a little bit of notation today. I'm going to refer to a time series as the sequence y sub t, where t will range from 1 to n. So n is the number of observations, if you like, in the time series. Now, the example I'm going to start with is a timely example, I think. It is the gross domestic product in the United States recorded on a quarterly basis. Actually, aggregate GDP recorded in billions of chained 2009 dollars, which means that it's real GDP, not nominal GDP. It's already been corrected for inflation. And it's also been seasonally adjusted. Now, I have this data actually loaded into Statgraphics. Here I am in Statgraphics, and you can see I actually have data beginning in Q1 of 1960 all the way through the first quarter of 2015. In addition to GDP, and I'll be making this data available incidentally after the webinar, so you can play with it yourselves. But in addition to GDP, I also have several other interesting coincident time series. I have the building starts obtained from the OECD, that's seasonally adjusted. I have housing starts in thousands of units from the Federal Reserve, and also construction permits in thousands of units from the Federal Reserve. Now, housing starts and permits are known to be leading indicators for GDP, and we'll be using them in our forecasting models today in attempting to forecast what's going to happen to the aggregate U.S. GDP. Now, I will again note that it is aggregate GDP. It's not per capita. It's aggregate GDP, so we would expect it to grow with the population even if the standard of living wasn't improving. Now, the first thing we normally do whenever we have a time series, of course, is we plot it out. And I'm going to take GDP and I'm going to plot it out by quarter for you. And you can see, looking at the time series from the beginning of 1960 through Q1 in 2015, that there have been fairly dramatic improvements in the GDP. It went from something like 3,000 up to about 16,000. And those are in billions of dollars, by the way. And it's been a fairly steady growth since 1960. Actually, if you take a look at the trend, you'll see that not only has it been fairly steady, it's been more than linear. It's clearly been growing at a faster than linear rate. And again, this is real GDP, so it's already been adjusted for inflation. And there have been a couple blips in the road, definitely in around 1980. You do see a 3 or 4 quarter reduction in GDP, which does indicate a recession. But since about the beginning of 2009, it's been growing fairly steadily again. Now, one of the reasons that this particular time series is of interest to us is what's happened recently. I'm going to right-click my mouse and actually use the zoom in feature of Statgraphics to give you a picture of the most recent quarters. And one of the reasons that the GDP has been in the news is that in the first quarter of 2015, there was a reduction. The GDP dropped compared to the fourth quarter of 2014. Now, it turns out that that number was revised this morning. Of course, that always happens, right? You prepare a webinar, and the morning you want to give it, they revise the numbers that you're using. There was a revision actually announced at 8:30 this morning, and it turns out, according to the BEA, that the GDP in the fourth quarter was, the first quarter of 2015, wasn't quite as bad as they thought it was. But I didn't have time to change all my notes. So I'm going to stick with their second estimate. This was actually the second estimate. The third estimate came out today. And we'll go ahead and try to forecast what's going to happen. Now, why it's of such interest, of course, is we need to know, or we certainly would like to know, whether the drop in GDP last quarter was the beginning of another recession or just a little blip. And it'll be quite interesting to see what our forecast functions do in terms of projecting what's likely to happen for the rest of the year. And that's what I'm going to emphasize and concentrate on in this webinar, is trying to forecast what's going to happen to U.S. aggregate GDP for the next 3 quarters. Okay. Now, let me undo that zoom and go back to the full picture of the data. And I think the first thing I'll do here is actually add in a lowest smooth. A lowest smooth is helpful in giving us an idea of what the underlying trend might have been in GDP. Okay, I'll make it a little bit thicker here. And you can clearly see that the trend has been up. And it's been up at an increasing rate. It's not entirely linear. Things were increasing. In fact, in 2006, 2007, things were increasing quite quickly. And then came the recession. But beginning in 2009, we've come back, not to what we would have projected perhaps from the data in 2007, but come back pretty much to the overall trend line. Now, there are a couple procedures in Statgraphics that are quite useful for looking at trends. The first one I want to show you is a statlet. I'm going to go to the top menu in Statgraphics and go to Statlets and choose curve fitting. What this will allow me to do is to take GDP by quarter and fit regression models to it. Okay, now what I've done in this case is simply do a linear regression. And you can see that clearly the linear regression is not a very good fit. You see the curvature of the actual data around the line. So things have, as I was trying to allude before, increased since 1960, increased at an increasing rate. Well, one of the things I can do is I can ask, for example, suppose I transform the values of y. What sort of transformation might be best at picking up the underlying trend? If I go up to the top toolbar on the Statlet and push Optimize Y, it'll go ahead and apply what's called a BoxCox transformation. And what that does is it takes GDP, raises it to a particular power, and finds the best power in terms of fitting the data. Now, this does not take account of any autocorrelation, so this isn't a perfect procedure, but it is giving me a general idea of what sort of transformations might linearize the relationship over time. And basically, Box and Cox say that something close to a cube root would give us a better model, certainly in terms of the mean squared error. On the other hand, I have found out playing with this data that although they think that a cube root might be best, if I change the power and make it a square root instead, GDP raised to the 0.5 power, that I actually get somewhat better forecast models. And you can see that that square root model also does a fairly good job in terms of modeling the data. Okay. Now, what we're looking at is the actual aggregate real GDP on a quarter-to-quarter basis. When we're doing time series analysis, let me go back to my PowerPoint slides. It can also be quite useful to think of the data as consisting of 4 different components. We have the overall trend, which in this case you can see is up over the 55 years or so in which that data was collected. There are cycles around that trend, and they were pretty obvious in the picture as well. It was above the trend line for a while, below the trend line for a while, and so forth. There could be seasonal effects in the data. You didn't see any, though, because what we're looking at has already been seasonally adjusted. So we're not going to have to worry right at the moment about the seasonality. We let the BEA take care of that for us in this case. And then finally, there's typically a random or irregular component. Okay, every time series has some random component associated with it, which means we're not going to be able to get perfect forecasts. Okay. And there's the trend analysis that I just did for you. Now, there are a couple operators that are quite important to understand when you're talking about forecasting time series. The first is differencing. We will refer to the first differences of our time series as the differences between the observation at time t and the observation at time t minus 1. If I talk about the first difference, that is how things have changed from time period t to time period t minus 1. Okay, the changes in the data. Sometimes rather than looking at the raw data itself, it's helpful to look at changes from one time period to the next. Okay. It's also helpful at other times to look at the second differences. The second differences of a time series are the differences of the differences. Okay, and I apologize, I see the notation changed a little from my first slide to the second. I meant to use this notation here. Delta y sub t, the change from one time period to the next, is the first difference. Delta 2y sub t will stand for the second difference. And the second difference is the difference of the differences. So if you take the difference between what happened at time t and t minus 1 and subtract the difference between what happened at t minus 1 and t minus 2, you get something called the second differences. Now, it's quite useful to look at these differences. Let's go back to Statgraphics, back to our XY plot here, okay? And instead of looking at GDP, I'm going to go back to the data input dialog box and tell it I want to look at diff of GDP. Diff of GDP are the first differences. And what you see here now is a plot of the changes from one time period to the next. You can see that, in fact, there has been some increase in the mean change from quarter to quarter. I said a moment ago that basically the data were increasing at an increasing rate. Okay, that means that the slope of the line was increasing, and the smooth through the first differences here is basically showing you changes in the slope of that trend line. Okay. If I go back to the data input dialog box again, and instead of asking for the differences of GDP, ask for the differences of the square root of GDP. Okay, this says first take the square root of GDP and then take the first differences. You'll see, in fact, that there's a much more constant mean for the first differences. The square root transformation does a good job of basically making the first differences stationary. A stationary time series is a time series with a constant mean and a constant variance. And there has been a little bit of change in the mean of the differences of the square roots. But basically, it's been pretty constant. And I found, as you'll see in a moment, that when we go ahead and we do forecasting, we actually get somewhat better results if we apply our models to the square roots of GDP than to the actual aggregate GDP itself. Slightly better models. There's not a big difference, but it does seem to be slightly better. Okay. So it's important to understand the differencing operators, and we will be doing some of that as we go along. Okay. Now, in this webinar, I'm going to be talking about two basic types of models. The first types of models are what we call auto-projective models. Auto-projective models take the time series that we want to forecast. They look at the past behavior of that time series and project it into the future. I see I wrote projected into the feature. I meant projected into the future. I'll change that before I publish this on the website. You take the dynamics of that time series, model it, and project it ahead into the future. The second basic type of model that we'll be looking at are models with leading indicators. Those are models that not only capture the dynamics, the past behavior of the time series you're trying to forecast, but also include past values of other time series variables. So for example, if I wanted to forecast GDP and I knew that the number of construction permits in the previous quarter was a leading indicator, I could add that to the auto-projective model. Okay, and here incidentally is a picture of two variables plotted on the same plot. You see the first differences of the GDP values there in blue. You also see the first differences of new construction permits. They're plotted in red. Obviously the scales are different. One's plotted on the left axis, the other on the right axis. You can see, I think you can see if you look at it closely, that these two variables do tend to move together. Not only do they tend to move together, but the number of construction permits issued tends to go up a quarter or two before the GDP. So when we get to the end of this webinar, our final model will actually include permits as a leading indicator for the GDP. Okay, well, let's talk a little bit about notation again. I need some notation in order for you to understand the types of mathematical models I'm going to be using. First off, we have the notation y sub t, which represents the time series that I want to forecast. I'm going to add some notation now for the forecasts. I'm going to let capital F sub t at the value k be the forecast of y at time t plus k using whatever information is available at time t. Okay, ft sub k is normally called the forecast function. It's a function that I fit using all the data I have up through time t, and it can forecast 1 time period ahead, 2 time periods ahead, 3 time periods ahead, and so forth. And I'm particularly interested in what that forecast function looks like in the case of GDP, let's say for k equals 1 through 3 for the second, third, and fourth quarters of this year. Okay. We also want to think about something called the one-ahead forecast errors. The one-ahead forecast errors are the differences between what actually happens at time t and what we would have forecast would have happened standing at time period t minus 1 trying to forecast 1 period into the future. Okay. These are normally called the one-ahead forecast errors. They tell us how much we missed trying to forecast 1 period ahead. And we can calculate these for all the different time periods in our data. And a good forecasting model will be a model that gives us small errors. And we'll tend to compute statistics like the mean squared error, the mean absolute percentage error, or whatever based upon these one-ahead forecast errors. Okay. Well, let's talk about different types of auto-projective models to begin. The automatic forecasting procedure, which I'll be demonstrating for you in Statgraphics, fits something on the order of 6 different types of forecast models. The first and simplest model that it will try is something called a random walk. In a random walk model, the current value, the latest data value you have, has all the relevant information for forecasting the future. If you know what the observation is today and it follows a random walk, that's all you need to know. The past history is irrelevant. Now, there are 2 basic types of random walk models. There's a random walk that has a constant and the random walk that doesn't. The most common is the random walk without a constant. If you don't have a constant, then the forecast function standing at time t for all periods in the future is simply your latest observation. Okay. You can modify that. You can actually add a constant value such that the forecast function at lag k, not lag, but k periods ahead, is y sub t plus k times delta. But again, the past history in this case is irrelevant. Now, one of the folks that got me interested actually in economic time series is a professor, Professor Bert Malkiel. He taught my microeconomics course when I was a sophomore in college. He wrote actually a famous book. It's called A Random Walk Down Wall Street. And in many cases, you know, as he mentioned in that book, the best forecast for what's going to happen in the future, if you're trying to forecast stock prices, is the latest closing price. I know we all try real hard to model the past behavior of stock prices, thinking we might get a leg up on trying to forecast the future. But for an awful lot of stock prices, they really do follow a random walk. It's equally likely that the stock price will go up or down today, and it's yesterday's closing price that is the best forecast. Anyway, it's an interesting book. It's called A Random Walk Down Wall Street. This is one of the models that we will fit when we run our automatic forecasting procedure, and I've actually seen it select the random walk as the best model when I've fed it some stock prices. Okay. A second type of auto-projective model that will be fitting to the data is what's called a trend model. In a trend model, the time series follows a deterministic trend with random fluctuations about that trend. There are different types of trend models. I've written down 3 of them. There are trend models in which you fit a linear function to your history. There's an exponential function. There's a growth curve type function and several other functions. Basically, if you're fitting a trend model to the data, though, you're doing a simple regression and assuming that you have independent errors around the trend. I haven't seen those turn out to be the best models very often, but they're there. A third type of forecasting model we might use is called a moving average. In a moving average, what you do is you typically look at the recent history of your time series. You average, let's say, the last C data values, the most recent C observations, and use that model to forecast the future. You can play with C, these called the span of the moving average, and get better forecasts in some case. But again, I haven't seen those particular models be particularly effective, at least in the data that I've tried to forecast. Now, that's in contrast, though, to exponential smoothing. exponential smoothing is actually a very useful forecasting procedure in which you basically take and combine the new information that you have at time t with the previous information that you've collected before time t. For example, in a simple exponential smoother, you might forecast k periods ahead by taking a weighted average using some smoothing parameter alpha, where alpha is between 0 and 1. Basically, you take a weighted average of the data that you obtained at yt and the forecast you would have made from the previous time period, the forecast you would have made at time t minus 1, looking one period ahead. You take a weighted average of the current data and the previous forecast to get a new forecast. Now, Statgraphics has several procedures, several different types of exponential smoothing procedures. It has a simple regression, it has simple exponential smoothing, it has linear exponential smoothing, quadratic, and seasonal smoothers as well. Now, these can be quite effective. And when we came out with version 17 of Statgraphics, we put together a new statlet that will do exponential smoothing. And it can be a very useful way to generate forecasts. I'm going to go back to Statgraphics now, back to the Statlets menu, and tell it I'd like to do some exponential smoothing. I'm going to tell it, let's do GDP by quarter, and I'll press OK. Now, what it will do is it will start with what we call simple exponential smoothing. Simple exponential smoothing assumes that future behavior will follow a horizontal line. In fact, let me increase this a little bit. What you see here on my statlet is you see the historical data plotted as point symbols. You see the one-ahead forecasts plotted as a straight line. And then you see the forecasts for the future given by the red line. Those are the best forecasts. And I think they're magenta lines, the 95% prediction limits. Well, I think you can see that simple exponential smoothing, at least with the particular alpha that it's picked right now, an alpha of 0.1, doesn't do a very good job. Now, there is an optimize button where I can tell it to find the best alpha. And when I push that optimize button, it said that using alpha of 0.99 will give me the smallest root mean squared error. Now, it still, unfortunately, gives me a horizontal forecast into the future, which doesn't seem to be particularly appropriate for the GDP. A better method, and one I found works real nicely in many cases, is something called Holt's linear exponential smoothing. Holt's linear exponential smoothing involves two parameters: alpha, which is used to estimate the level of the series, and beta, which is used to estimate the slope of the forecast function. Let me click Optimize again, and actually it says we'll minimize the mean squared error if we use an alpha of 0.99 and a beta of 0.31. You can see that the forecast in this case is linear. You see the 95% forecast limits. And although the forecasts are that GDP will rise over the next 2 years. And I've asked it, I think, the forecast, I've asked for 17 forecasts, so it's forecasting several years ahead. It suggests an increase in GDP over the next 17 quarters. However, the 95% limits don't preclude the possibility that it might go back down again. I mean, look, it did go back down in 2008, and the forecast function is hedging its bets a little, saying that, yes, in fact, it's quite possible that it may go back down again in the future. Now, I can move the cursors with this little button on the slider. Let me bring it back to Q2 15. Okay, that's this quarter. It'll end in about a week, the second quarter of 2015. And the best estimate from Holt's linear exponential smoothing is that the GDP will be 16,334.4. I'm going to write that down, 16,334.4. Now again, that's aggregate GDP. Okay? It's real because it's in chained 2009 dollars, and it's seasonally adjusted. That is the number, though, that's normally shown in the news. Okay, so I've taken the data series that you're most likely to hear in the news, and it suggests that there will be somewhat of a rise in GDP. This previous quarter, quarter one, it was 16,264.1, which this morning actually they increased, and I know I wrote down someplace what they increased it to. They came up with a third estimate of GDP. Yeah, actually they said instead of being 16,264.2, it was, no, I know I wrote it down someplace. I'll find it in a minute for you. They brought it up to about 16,290. They brought it up about $30 billion. Okay. But using the data as of yesterday, the estimate for quarter one was 12,264. We're forecasting it'll go up to about 16,334. That is incidentally about a 2% annualized year-over-year increase in GDP. And since the population's only going up by about 0.75, a 2% rise in GDP does indicate an increase in the standard of living. Anyway, that's exponential smoothing. It can be quite a useful method for forecasting data, particularly economic data. It does a pretty good job on GDP. Now, there's one other type of auto-projective model, though, that I want to talk about, which is also very, very important. And it's what we call ARIMA models, Autoregressive Integrated Moving Average Models. ARIMA models are parametric models which basically describe the system dynamics. They look back into the past and try to capture the correlations, the dynamics that occur over time. A basic ARIMA model is normally referred to as an ARIMA PDQ model. It's a model which has an autoregressive term of order P, a moving average term of order Q, and is applied to the differences of order D. Okay? Now, let me show you some typical ARIMA models. Here you see a slide showing you what autoregressive models typically look like. Here's a first and second order autoregressive model. The first order autoregressive model says that the data at time t is a mean plus some multiple of the deviation of the data from the mean at the previous time period plus epsilon, where epsilon is a random shock, typically assumed to be normally distributed. So an autoregressive model of first order basically regresses the data at time t on the data at time t minus 1. An AR2 model, on the other hand, regresses the observation at time t on the data 1 time period back and also 2 time periods back. Moving average models are a little different. A first order moving average model says you can express the observation at time t as a mean plus a random shock at time t minus some multiple of a random shock that occurred 1 time period back. An MA2 model says the data could be represented as a mean plus some combination of the shocks that hit the system, now 1 time period back and also 2 time periods back. You can also take and combine autoregressive terms with moving average terms. Here's a typical model expressing y sub t using 1 autoregressive term and 1 moving average term. And if you wanted to think about ARIMA models, an ARIMA model says, well, let's not just build this ARIMA model for the data, let's difference the data first. And I've written down here what's called an ARIMA 1-1-1 model. In an ARIMA 1-1-1 model, you first calculate the differences of the data, the first differences, by taking the observation at time t and subtracting the observation at time t minus 1. You then use these first differences in your ARIMA model. So the change at time t is a function of the change at time t minus 1 plus the shocks that hit the system. And I also note that the constant term is sometimes omitted when you fit ARIMA models. Okay. Now, I want to take these different models and find the best. And a good place to go in Statgraphics to find the best forecasting model is our automatic forecasting procedure. I'm going to go to the Statgraphics top menu to forecast and tell it I want to do an automatic model selection. What this is going to do is this is going to take all those forecasting models I showed you, fit them all, and find the best automatically. This is what would have taken a long time when I first started teaching the subject, but is quite easy to do these days. It wants to know a couple things. First off, it wants to know what column has the data, and the data in this case is GDP. It would like a column with the time indices, that's called quarter. Okay. I'm going to tell it down here that I want to forecast the next 3 values. That'll be quarter 2, quarter 3, and quarter 4 of 2015. I have the option if I want to withhold a certain number of time periods for validation. If I don't withhold anything for validation, it will use all of the available data to fit my models and choose the best model. Some people like to withhold some of the most recent data. For example, I might tell it withhold from the fit. Don't fit the data, don't fit my model with the last 8 observations, the last 8 quarters, for example. But calculate statistics for those 8 quarters using the models fit to the prior data. It's sort of an independent validation. You know, if you use data that was not used to fit the model, then you have a purer estimate of how good those models will be to forecast ahead. If I don't withhold anything, my statistics are going to be basically based upon how well I fit the data, not necessarily how well I can forecast the future. Okay, I'm not going to use that option here, but I could. You'll also notice a column here called Trading Days Adjustment. I'm not going to put anything in there. I'll talk about that in just a couple moments. Okay, let's go ahead though and press OK. Now, this is going to lead me to a dialog box where I can select the different models I'd like it to include. I can tell it, go ahead and fit those random walk models, go ahead and fit the different trends, try a moving average, try various types of exponential smoothers. And I can also tell it the most complicated ARIMA model I'd like to try. I'm going to tell it, for example, try ARIMA models with up to 2 AR components, 2 MA components, and the second differences. And by the way, let's include the constant as one of the as a possible model. Now it'll fit actually ARIMA models with and without the constant and see which works the best. It's going to fit all of those. Okay? Now, how is it going to choose what model is best? Well, I specify that up here where I specify model selection criteria. We have 1, 2, 3, 4, 5, 6 different selection criteria that we can specify. And what it will do is it will find the model that gives the best value of whatever I indicate I'm interested in. Now, I'm going to use the default value here. The default value for selecting a model is the Akaike Information Criterion. The Akaike Information Criteria, or the AIC, is basically a combination of the root mean squared error, which is the square root of the average of the one-ahead forecasting errors. Basically a measure of how well I fit my data, plus 2C divided by N. C is the number of coefficients in the fitted model, N is the number of data points. So basically what it is, it's a penalized mean squared error. We penalize a model if it has too many parameters in it. You've all heard of the KISS principle, I'm sure. Keep it simple statistically. We prefer models with less parameters. And the Akaike Information Criterion specifically includes a penalty if you have too many parameters. Now, this is a criterion we'd like to be small, so whatever model gives the smallest AIC is going to be the best forecasting model. Now, there's also a button on the analysis toolbar that will allow me to do adjustments of my data prior to fitting my models. And I am going to ask it to take a square root of my data before it fits the models. You can ask Statgraphics to adjust your data actually in various ways. You can ask it to adjust for trading days. What a trading day adjustment does is it basically normalizes data based upon the number of trading days in the period. For example, let's suppose I was looking at monthly sales data. Okay? Some months have more trading days than others. Right? Some months have more days. Also, some months have more Saturdays and Sundays. So if certain months had more trading days than others, you might like to adjust your sales data to put it on a per day basis before doing your forecasts. In Statgraphics, if you give it another column on the data input dialog box, will divide your data by the number of trading days. Excuse me. I'm not going to worry about that here. Oops, sorry, I pushed the wrong button. Okay, what I wanted to do was go to the next slide. Another adjustment is what we call a math adjustment. We can tell the program to take each of the time series values, transform it before it fits. And this I am going to ask it to do. I'm going to ask it to take the square roots of my data and fit the models to the square roots. It'll fit the models to the square roots, generate the forecasts for the square roots, but then invert the transformation to give me back data in the original metric. So basically, it'll take a square root, it'll fit a model, it'll get forecasts, and then it'll square the forecasts to give me forecasts for the original values. Okay, and there are various types of math adjustments we allow. We could also ask it to do a seasonal adjustment. Now, we don't need to do that here because the data have already been seasonally adjusted. But we do have the ability to tell it, please seasonally adjust my data before you fit the model. Okay, in that case, it would take data, it would seasonally adjust it, it would fit the model, generate the forecasts, and then put the seasonality back into the forecasts for me. Whatever adjustment it does prior to fitting the model, it undoes before it shows you the forecasts. And finally, it could also do an inflation adjustment. It could correct the data for some constant rate of inflation. Now, we don't need to do that here either. These are already deflated numbers. They're all $2009. It's real GDP. So the only adjustment we're going to have to do here is actually going to be a math adjustment. So let's go back to Statgraphics. Let's push that adjustments button and tell it we'd like to do a square root. Okay, we can then press OK, OK again, and it has now gone ahead and fit the data. And in fact, it has decided that the best fitting forecast for GDP is an ARIMA 210 model with a constant. That's a second order autoregression done on the first differences of the data with a constant term. Okay? And actually, let me zoom in again on these forecasts so you can see what the forecasts look like. The forecast for the next quarter is that GDP will go up somewhat compared to what it is in Q1, and then will continue to rise throughout the rest of the year. Again, you see 95% limits for the forecasts, and it's not beyond the realm of possibility, not beyond the 95% realm of possibility, that in fact GDP might go down again. Best guess is that it will go up, but you know, we shouldn't be too surprised if it goes back down instead. Okay, well, let me show you some of the other output that you get from the automatic forecasting procedure. Up here in the summary, you see various information about the model that was just fit. We're looking at GDP in billions of change, $2009 seasonally adjusted. There were 221 observations. It took a square root math adjustment and selected an ARIMA 210 model with a constant. Okay. It's giving me some statistics right here on the one-ahead forecast errors. It says that the root mean squared error, for example, is 64.215. That's in billions of dollars. The mean absolute percentage error, here's one I like here too. Mean absolute percentage error. How big was the one-ahead forecast error in percentage terms? Well, it was about 0.57%. I erred on average in forecasting 1 quarter ahead by about 0.57%. Okay. There's also a summary of the fitted model. You see a first-order autoregressive term, a second-order autoregressive term, and a mean. Each of those has a p-value. Any p-value below 0.05 is significant at the 5% significance level. So in fact, both the AR terms and the mean are significant at the 5% level. Okay. Now there's also an interesting panel that comes up, an interesting table that gives a comparison of all the different models. It will compare for you the random walk, the trend models, the exponential smoothers, and so forth, and also the best 5 ARIMA models. Model M is the best. It's the 210 with a constant. In ARIMA, 111 was second best, ARIMA 110 third best, and so forth. Okay. This table right here summarizes during the estimation period all of those different models, and it picked Model M. Model M gave the smallest value of the AIC. You can see that right there, 8.35162, the smallest value of the Akaike information criterion. It will also do some tests of the residuals. Down in this part of the output, it actually runs a number of different tests. It does a runs test for successive runs up and down. Basically looks at the residuals and says, do these residuals look random or not? If my model is fit well, if I've captured all the random dynamics of the data, then there shouldn't be anything left in the residuals. So it looks to see whether there are excessive runs up or down in the residuals. It also looks for excessive runs above and below the median. It does what's called a box Pierce test for excessive autocorrelations. It compares the mean of the first half of the residuals to the second half to see if the mean is different. It looks for a change in variance of the residuals in the first half to the residuals in the second half. The table will have an OK for a particular model if the significance levels, the p-values, are all above 5%. And you can see Model M passes all the tests. The residuals from Model M look quite good. If it fails a test, a model fails a test, it'll put 1 asterisk if it fails at the 5% level, 2 asterisks if it fails at the 1% level, and 3 asterisks if it fails at the 0.1% level. You can see, though, that our particular model, which is Model M, actually does quite a good job. Okay. Now, one other graph I wanted you to see here, which came up by default, was the residual autocorrelation function. An autocorrelation function is a function that looks at a time series and looks at values separated by 1 unit of time, 2 units of time, 3 units, 4 units, 5 units, and so forth, and basically calculates the correlation between observations, or in this case, residuals, at a particular lag. If our model has worked well and we've captured all the dynamic structure of GDP, then the residuals should be random. There should not be any significant correlation, nothing outside these 5% bounds, if we've captured the dynamics in GDP. This model looks beautiful. Okay, I've got all my residual autocorrelations inside the 5% level, meaning that I've done a very good job with this model in capturing the dynamics of the past behavior of GDP. Okay. If you saw a big spike someplace, it would indicate that the residuals were correlated at some particular lag, which might mean that there was something going on that you had missed. Okay. This is what it should look like. This means that it's done quite well. Okay, that's good. Now, it doesn't mean that we're done. Just because we have random residuals doesn't mean we necessarily have the best possible model. We can still improve it, and one way to improve it is by putting in leading indicators. I'm going to go back to the list of tables and graphs and now ask for the residual cross-correlation function. The residual cross-correlation function will allow me to calculate the correlation of the residuals with other variables. And what I'm going to do is I'm going to push the right mouse button, go to Pane Options, and tell it that I'd like to calculate the correlation of my residuals with diff of permits. That will be the first differences of the construction permit time series. Okay. Now, there's also a checkbox which says, do I want to apply adjustments to the second time series, which would mean, do I want to do square roots? Because permits, the way I was doing square roots of GDP, I'm going to say no. I'm just going to ask for the cross correlations. And this is what I was hoping to see when I first did this. I have my best auto-projective model, but now I'm computing correlations between my residuals and changes in construction permits at time t, at a lag t-1, a lag t-2, t-3, and so forth. If permits, it leads my GDP, the time series I'm trying to forecast, then I should see a significant cross-correlation, a correlation between GDP and permits at a lag of 1 or a lag of 2 or a lag of 3. The way Statgraphics calculates the cross correlations, you're interested in the positive part here if you're looking for a leading indicator. And it definitely seems that the change in permits, okay, leads GDP significantly, at least by 1/4. Now that's great. That means I can improve my forecasting model if I add permits to it. Now, let's go back to the PowerPoint slide and talk about the last type of models we want to talk about this morning. And that will be models with leading indicators. Let me go up. I've got this up ahead here someplace. There it is. What we're going to do is we're now going to add a regressor variable to our ARIMA model. We're going to add our construction permits lagged 1 quarter, and maybe more than that, to our ARIMA model with the hopes that we can improve the forecasts of GDP. Okay. Now, when we do this, it turns out the way to do it is you add regressors to your ARIMA model, and you actually apply the same differencing and autoregressive operators to your X variable as are being applied to your Y variable. So if I difference GDP, I'll difference permits. If I fit a second order AR term to GDP, that same AR transformation will be made to X. Okay? We do this because what we're doing is essentially fitting in a RIMA model to the errors of the regression of Y on X. We are essentially regressing GDP on lagged values of construction permits. Okay? Assuming, though, that the errors are not random, but the errors follow in a RIMA model. Okay. Now, there's a very helpful discussion of this that Professor Robert Now at the Business School at Duke did. You can find it at the URL that I've written here. Okay, Bob Now was very helpful when we were initially writing the routines in Statgraphics to add the regressors, and helped us make sure we did it properly. If you take a look at that particular link, he has a nice discussion of exactly how these leading indicators are handled in an ARIMA model. So I definitely recommend that to you. Now, there is one complication. If I want to use a time series such as permits in my model for GDP, and I want to forecast out into the future, I'm first going to have to generate a forecasting model for permits. You know, if I want to forecast Q2 using lag values of permits, I need Q1. If I want to forecast Q3, I need Q2. If I want to forecast Q4, I need Q3. So before I can actually add permits to the model, I'm going to have to generate a forecast model for permits, which I'm going to do in just a moment. We'll then take the forecast from the permits model, add it to the bottom of the data sheet in the permits column, go back to our forecast for GDP, and add the regressors using analysis options. Okay, so let's go ahead and do this. This will just take a couple moments. Now, permits, as I said, is another column in our data sheet. In order to construct forecasts for permits, I'm going to go to Forecast, Automatic Model Selection. This time, tell it, though, I want to forecast permits by quarter. Okay. I'll tell it, try all the different models, including a possible constant term. I won't do any adjustments. I don't need to do the square roots here. I'll just press OK, OK. and it'll generate a forecast function for permits. Okay, this is a plot of new construction permits, and you can see new construction permits have been going up quite nicely over the last 3 or 4 years. It's decided, in fact, that a good forecast model here is an ARIMA 202 model with a constant. Okay, so that's a plot of construction permits with the forecasts. In order to see the forecasts, I'll go to the forecast table over here. I'll scroll down to the bottom, and here you see the forecasts for quarter 2, quarter 3, quarter 4 construction permits. Now I'm going to write down these numbers: 1088.9, 1117.32, 1148.04. Those are my forecasts for new construction permits. I'll go back to my data sheet. I'll go down to the bottom of the data sheet. I'll put in for quarter 2 of 15. I'll put in data for quarter 3 of 15, for quarter 4 of 15. Okay? I'll go out to my permits column, there it is, and I'll type in my forecasts. It's 1088.9 for quarter 2. It's 1117.32 for quarter 3, and it's 1148.04 for quarter 4. I need those forecasts to forecast GDP. Now, I'll go back to my automatic forecasting procedure now for GDP. Okay? I'll right-click, go to Analysis Options, and now you see a button on the Analysis Options dialog box that says Input Series. This is where I can add up to 5 different regression variables. And I'm going to tell it that I want to lag permits by 1. That says use the values of construction permits 1 period back in time as a regressor in my forecast model for GDP. I'll then press OK, OK, and it's now fit in a RIMA 210 model with a constant plus the 1 regressor. And you will see right here in the summary of the analysis, lag permits, comma 1, with a very, very small p-value, 0.000000. It has entered significantly into the model. You'll also see, if you look at the cross correlations, that it's knocked out pretty well the cross correlation at lag 1. Well, I've played with this data a little bit, and I've actually found out that I can put in up to 3 lags of permits. I can put in lag permits, comma 2, and lag of permits, comma 3. Press OK, OK. And I will get significant results right here, significant p-values for construction permits lag 1, lag 2, and lag 3. Okay. And you can see in the cross-correlation function that it's knocked out quite well the cross-correlation in the residuals. Okay. Now, you'll see also up here what the forecast function looks like. It doesn't look a lot different, although I'll show you in a minute, it is a little bit higher than it would have been had I not used those leading indicators. Okay. So we now have a pretty good forecast model for GDP. And if I go back to the forecast table, we can actually write down what we think is going to happen in the second quarter. The forecast here is 16,334.8. That is my best forecast for real GDP, seasonally adjusted, aggregate throughout the United States for the second quarter of 2015. And in about a week, I'm going to find out how good a forecast that actually is. Okay, a couple notes for you. That is very typical use of leading indicators. Oh, here's a plot I made using the overlay facility in the stat gallery, showing you the forecasts with and without the leading indicator. The brown line here is the forecasts that were made by the ARIMA 210 model with a constant but no leading indicators. And the red lines here are its 95% forecast limits. Once I put the leading indicator in, two things happened. First off, the forecast function went up a little bit. It's a little steeper than it would have been without the forecast function. And also the 95% bounds have tightened. That's not unexpected. We picked up some of the residual variability, so our forecast limits are tighter than they were. But it looks like, at least according to our models, that this is not the start of a new recession, that it's just a little bit of a blip on what appears to be a constant rise in GDP. Okay, one note. At 8:30 this morning, I came into my office, and I noticed that the Bureau of Economic Analysis announced a third estimate of Q1 2015 GDP. Of course, it had to happen the day I was going to give the webinar. Didn't give me any time to change my slides. They raised their estimate, incidentally, of quarter one from 16,264.1 to 16,287.7, about $21 billion higher. That actually revised the annual rate of change from minus 0.7% in the first quarter to only minus 0.2%. It was still down, but not down as much. And actually, I put in the new values. That changes our quarterly forecast from the value we just quoted, 16,334.8 to 16,361.5. So it adds about another 17 billion to our forecasts. Incidentally, we're forecasting about a 2% growth in GDP year over year, although with their new revised estimate of quarter one in 2015, it looks like quarter two could come in maybe at about 2.2% growth. As I said, we'll find out in a week or so at least what their first estimate is for the GDP in quarter two. Okay. Where'd my data come from? I'm going to post the data, incidentally, on our website, so you'll be able to try all this on your own and see if you can come up with an even better forecast model than I came up with. The new private housing units, the permits data, came from the Federal Reserve Bank of St. Louis. The GDP values came from the Bureau of Economic Analysis of the U.S. Department of Commerce. They're freely available on the internet. You can download lots and lots of economic time series, either from the Fed or from the BEA. And finally, the two references you might be interested in. The main reference for the ARIMA models is Box and Jenkins. Box and Jenkins wrote a book now in its 4th edition called Time Series Analysis, Forecasting, and Control. And then I have also put here the book that Bert Malkiel wrote called A Random Walk Down Wall Street, the Time-Tested Strategy for Successful Investing. Lots of statistics in there. As I said, Professor Malkiel taught my first course in microeconomics. That book is now in its 11th edition. I don't want to tell you how old that makes me, but it is in its 11th edition. Okay, that's what I wanted to present today. I hope you found that interesting. It is a very interesting subject. We will be posting at www.statgraphics.com we're going to put the recorded webinar up there so you can watch it again, or if you think it's useful for one of your colleagues to watch, point them to it. I'm going to put my PowerPoint slides. We're going to put all the sample data up at www.statgraphics.com. Just look on the top menu for instructional videos, and you'll be able to find all of that particular information. Okay, now I think I forgot to tell you that you could submit questions. I've got maybe about 15 minutes left here to answer any questions. There's a facility in GoToWebinar here that lets you type in messages if you have any questions. I was sent actually 14 different questions ahead of time from someone who uses Statgraphics a lot, very heavily, for forecasting data. While I wait for any of you to send your questions, I'll answer a few of these. I'm not going to answer all 14. I'll write up answers to all 14 and email it, but let me see if I can answer a couple of these questions. One question I was asked: should I use regressors to improve the autocorrelations if the standalone model, that's the model without any leading indicators, has no lags outside the bounds? And the answer to that is absolutely. We saw in this case, when we looked at the autocorrelation functions of the best auto-projective model for GDP, that all of the autocorrelations were within the bounds, within the 5% probability bounds, meaning there was no significant autocorrelation left in the data. However, there was significant cross-correlation left in the residuals with construction permits. Enough so that if we added construction permits to our model, we could reduce the variability of the data. So just because your model may be good and clean and so forth without leading indicators doesn't mean you couldn't do better if in fact you do put leading indicators into the model. And that's what we're definitely seeing. Okay. Let me look for another question. Oh, here's another interesting question. Suppose I'm fitting quarterly data like GDP. If we see an out-of-bounds lag at 5 or greater, should I care? Okay. The way I interpret that is, suppose I see an autocorrelation, a residual autocorrelation at lag 5 or earlier, and I'm using quarterly data. Should I care? And I would say, yes, you probably should. At least, if it's just outside the 5% bounds. Well, 5% bounds are violated 5% of the time. So I don't worry too much if I see some autocorrelations just outside those 5% bounds. But if it's quite a ways outside, it says that there's some correlation between residuals separated by 5 quarters. What that means, I have no idea. I mean, is there a business cycle with a period of 5 quarters? I don't know. But it might worth at least investigating why there is a significant correlation at lag 5. Now, if it was lag 8, of course, that's exactly 2 years back. If there was a significant correlation at lag 8, it may be that you didn't deseasonalize the data well enough. You know, that you're missing a seasonal effect 2 years ago. But yeah, even autocorrelations beyond lag 4 when you're working with quarterly data could be interesting to examine. Okay, there was another question. When using cross-correlations dialog box, what does apply adjustments to second time series mean? As this person guessed, when I'm looking at cross correlations down here, I right-click and go to pane options. When it says apply adjustments to second time series, it means that whatever adjustments you apply to the first time series, you should apply to the second time series. And that would mean mathematical adjustments, seasonal adjustments, inflation adjustments, trading day adjustments. All of them, whatever had been applied to the first series, would also be applied to the second series. Let me just see from Brendan. Do we have any other questions that I've missed?
I believe I've sent you a few in the chat box.
I don't see any in my chat box. Okay, let me see why I'm not seeing them. Okay. Maybe because they're in the questions box. Okay. I missed the questions box. Okay, let me go up and yes, you did send me quite a number. Let's see what I can do. How are control charts related to time series charts? Aren't they the same? Well, the ARIMA models are in fact the same. I talked, I think it was either last month or 2 months ago, about ARIMA control charts. And you are, in fact, when you do ARIMA control charts, fitting the same sorts of models as I'm fitting here. The purpose is different, though. The purpose in the case of a control chart is to remove the autocorrelation from the historical data so that I can see whether there were any unusual data values, unusual events that occurred in the past. You may remember that one of the charts we looked at when we did the ARIMA control charts was a chart of the residuals. Were there any big residuals in the past that might have indicated a significant event? Here, when I'm using them for forecasting, I'm more interested in projecting into the future. Projecting past behavior into the future so that I can get a forecast for what's likely to happen ahead of time. So although the mathematical models are the same, the motivation is quite a bit different. Okay. Question, can we handle non-equidistant data in the time series procedures? All of the procedures, all the models we fit here assume that data are equally spaced in time. Now, there's no real way around that. Having said that, though, it is possible if there are a few missing values, occasional missing values, that you can leave a cell blank. And the first thing Statgraphics does, if it sees a blank cell in a forecasting procedure, is it estimates what should go into that cell. If I want to fit an ARIMA model, I need data for every quarter. If there's missing data at particular quarters, the first thing we actually do is use an interpolative procedure to estimate what would have been in that empty cell. We put it in there, and then we fit our models. In general, though, those points do have to be equally spaced in time. Okay. How can we do an X11 or X13 model? Is it possible using scripts? In X11 and X13 are methods for seasonally adjusting data. We have a classic seasonal adjustment in our time series procedures. If you go to describe time series seasonal decomposition, you can apply what's called the classical ratio to moving average method to seasonally adjust the data. Now, that's not an X11 or X13 procedure. X11 and X13 are procedures for seasonally adjusting data that have been devised, I think, by the Census Bureau. They include methods for handling outliers. They include somewhat more complicated moving averages than is used in our seasonal decomposition procedure. I don't know if it's possible to put together a script to do that. It certainly would be a nice addition to the next version of Statgraphics to do some more complicated seasonal decompositions so that we could, for example, take unseasonally adjusted GDP and seasonally adjust it ourselves. At the moment, we don't have anything built in to do X11 or X13. I do have it on the list for possible additions to the next version. There is a comment that I did not say much about seasonality or periodograms or anything like that. I apologize for that. I got so caught up in this GDP and there was so much to say that I didn't have time to do that. I promise in a webinar soon that I will handle periodic data, and I will have some things to say about the seasonal data. We'll try to do that probably in the early fall. I just didn't have time. I had so much to say today. Another question. In the case of controlled experiments, how to differentiate between the autocorrelation effect and the regressors effect when adding them to the model? How do we differentiate between the regressors effect and the autocorrelation effect? Well, you can see if you look at the coefficients of the model, the best fitting models, that when we put in the leading indicators, it, for one, knocked down the order of the autoprojective parts of the model. When we were doing an autoprojective model, it was an ARIMA 210 model. By the time I put in the first 1, 2, 3 leading indicators here, it didn't need that complicated AR2 model anymore. It knocked it down to an AR1. And in fact, the AR1 term is just not, well, it's not quite statistically significant at the 5% level. It's much less important than it was before. Now, how do I separate out the effects? That's a very interesting question, right? These are two time series that are moving together. Why are they both going up right now? Why are housing permits going up and GDP going up? Well, probably because other factors are pushing both of them up. So I can understand, boy, it would be nice if you're thinking designed experiments to be able to separate out the effects of the regressor from the internal effects of GDP. My guess is, though, that it is other external variables that are pushing them both. And in a forecast model, I don't care as much what's pushing them. If I can find one that moves before the other, then I can use it to improve my forecasts of the second variable. So I don't really know how to separate the effects of the regressors from the internal, although you can certainly see that change in permits is explaining much of what the autoregressive model terms were explaining before. Can you repeat, please, is another question. Can you repeat, please, what is the meaning of the estimated cross correlations for the residuals chart and the line blue? Okay, oh, this blue line is just at lag 0. We have positive correlations in this direction, which would indicate that the regressor was a leading indicator, and correlations in this direction, which would mean that the variable was a lagging indicator. If permits moves before my residuals, we see correlations on the right-hand side of 0. If permits were to move after GDP, we'd see significant correlations on the left. And there is a little bit of movement on the left. That's any sort of lagging indicator is not going to help me make a forecast, though. I need regressors that move before the variable I'm trying to forecast. Okay. Another question, where can we read more articles about case studies forecasting with Statgraphics? That's interesting. I would do a Google search of Statgraphics forecasts. I can have someone here actually do that, and perhaps we can put some references also up on the website. We're going to put up, as I said, the PowerPoint slides and sample data and the recorded webinar on our website. I'll have someone look for some case studies. I know there are some out there on the internet, and give you some other references at that same location of articles you might like to read. Okay, well, that was the last question that I saw in my list here, so I thank you, as always, for the attention that you have paid during the webinar. It's always encouraging to see that almost everyone who was here at the start is here at the end. Any other questions I will respond to in writing. For the person that sent me the 14 questions, believe me, I will respond to the others in writing, but I've used up my allotted time and a little bit more here. So I'm going to sign off for today. You all have a good day. It's a beautiful day here in Northern Virginia. I hope it's as nice wherever you are. So long.